I said it was the worst example of fiscal drag. Well, why is that? It's because that 100,000 limit was introduced back in 2010. So that has not moved in 15 years. Almost certainly won't move again this time round. You'll hear basically nothing about that. But that's very, very, very significant. Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm pleased to welcome back to the pod Tom Stevenson, Investment Director here at Fidelity. And we're talking today about income tax, a subject that's never too far from the headlines, particularly in the run-up to a big financial set piece like the budget. This time, the chatter around income tax is noisier than ever. The truth is, however, that we don't need any new tax rises in the budget for more of our earnings to be taken in tax. It is happening anyway. We'll explain why today and assess the chances of more tax rises to come. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel. Give us a like, join the discussion in the comments if you want to do that. It really does help others find what we're doing here, and it means that you'll get new content as it is released. That all said, Tom, welcome along. How are you?
I'm very well, thanks, Ed.
Good stuff, good stuff. Now, there are some reports that we could see a rise in income tax at the budget, which is in about 3 or 4 weeks' time. But why are some people saying that we are already heading for higher income tax?
Yes, I mean, there is a possibility that income tax will rise at the budget. It's fairly unlikely, I think, given the way in which prior to the election, the government tied its hands by promising that it wouldn't raise income tax, and VAT and employee national insurance. But as you teed me up to say, it doesn't really matter, because there are ways in which the government can increase its income tax take without actually raising the headline rate of income tax. And the way it does this is, we call it fiscal drag. It's by essentially freezing the thresholds at which people move into a higher rate of tax. So as that happens, as your salary rises, or as salaries rise generally, more and more people are sucked into that higher rate of income tax, and it's a big revenue raiser for governments. Absolutely,
and what we've seen, and we're going to go into detail on this today and look at the numbers, but thresholds have been frozen for several years now. That's actually quite an extreme form of fiscal drag. You can still perform fiscal drag or get the effect by simply raising the rate by less than wages rise, right? Yeah. That's all you need to do, and then more wages fall into those higher brackets. But we can put some numbers on those frozen tax bands. So we've got the personal allowance. That's the first amount of earnings that can be earned without any tax applying. That's been frozen at its current level of 12,570 since April 2021. The higher rate threshold, where 40% tax begins, has remained at 50,270 for the same period. The additional rate threshold and 45% tax has actually fallen. So that, sort of has widened the net, if you like. And that now begins at 125,141. And it was up at 150 in 2021. So under plans announced actually by the previous Conservative government and then maintained by Labour, they're going to stay at those levels until 2028, at which point the freeze will have been in place for 8 years. That's 8 years of growing wages. That is a long time, and a big accumulative fiscal drag over that period.
Yeah, and I think you make an interesting point there, which is that that this was put in place by the previous government. So this is not a party specific thing. It is such a lucrative way for governments to raise money without really people thinking
paying the price.
They're paying the price.
You don't get that.
It's so attractive that everyone's going to do it.
Yeah, you just simply don't. We know about it, and lots of people, there'll be lots of coverage about it. But for most people, let's face it, as soon as you start talking about thresholds and fiscal drag, they'll tune out. Which is not the same as what happens when there's a penny on income tax.
Yeah, and you're right to talk about the cumulative effect, because in any given year you say, oh well, okay, it's frozen for this year, it doesn't really matter. But if you do that every year for 8 years, that makes a huge difference, because people's incomes rise over time, and over an 8-year period they might rise by a considerable amount. So that will drag a lot of people into that higher rate tax band.
Yeah, and there's loads of different ways and numbers you can use to show that effect. And we're going to bring something up on the screen now that does that. This shows what's happened since 2020 and this long period of frozen tax thresholds, Tom. The figures in the kind of yellow-green columns, they show how many higher rate taxpayers there are now and how many additional rate taxpayers there are. This is all according to HMRC figures. The number of higher rate payers has jumped from just below 4 million to just above 7 million. That's a rise of 78%. And for additional ratepayers, that's even a more extreme effect, jumping from just below 500,000 to almost 1.25 million. Really significant increases, Tom, in quite a short period of time.
Well, I think that's the point, isn't it? I mean, to go from 4 million to 7 million over a period of time would be one thing, but for it to happen over a period of just 5 years.
Yeah, it's really accelerated.
It's really accelerated. I mean, that's needless to say, that's a lot of people.
Yeah, and one final number for you. All of this taken together means that there are now 21% of people who pay income tax now fall into these higher or additional rate bands. That's more than 1 in 5. Look, still a minority, and these are still the highest earners in the country, but it's a significant minority and it is growing.
Yeah, I mean, a couple of points there. I mean, I look back actually further than this, back to because you can get the figures going,
Sure.
all the way back. I look back to the early 1990s, and I think the equivalent figure then was about 3% of people were higher rate taxpayers.
Yeah.
So back at the beginning of my working career, it was quite unusual to be a high rate taxpayer.
Yeah,
it's not now, and also because of that freeze. I mean, £50,000. Okay, that's significantly higher than the average salary. But I mean, I think many people earning £50,000 a year would not consider themselves to be particularly wealthy, and for them to be captured by what's termed a higher tax rate, might seem a bit unfair to some people.
Yes, indeed. Now, there is one even more extreme example, I would say, of fiscal drag in the income tax system. Doesn't get as much attention, possibly because it affects people at the even higher levels of earnings. But it concerns the threshold at which your personal allowance is tapered away. Now, slightly technical issue, but the personal allowance, we've mentioned it, that's the tax-free bit of earnings, the first 12,500-ish that you can earn without any income tax. Once your earnings hit £100,000, things begin to change. What happens at that point?
Yeah, well, you're right. This is quite complicated. And of course, this is why it works, because most people don't understand it. So what essentially happens is that as your earnings rise above £100,000, for every £2 that your salary rises, you lose £1 of that personal allowance, and that's why it's that band from 100,000 to about 125,000. I can't remember the exact figure.
Yeah.
Over that band, essentially your personal allowance tapers down from roughly £12,500 to zero. So if you're earning £125,000, not only are you then tipped into the 45% tax rate, the higher. There's not higher; it's the additional tax rate.
Yes.
Kicks in at £125,000. For that £25,000 worth of salary between 100 and 125, you've effectively paid a 60% rate of tax. And why that works is because you're paying 40% on each pound of earnings, and you're losing 20% from the personal allowance. So it's really difficult to understand, but it's really punitive.
Exactly. And lots of people would have heard of this 60% effective tax rate, not an official tax rate, but it's effectively what happens because of that withdrawal of the limit. And I said it was the worst example of fiscal drag. Well, why is that? It's because that 100,000 limit was introduced back in 2010. So that has not moved in 15 years, almost certainly won't move again this time round. You'll hear basically nothing about that. But that's very, very, very significant. Someone earning £100,000 in 2010 is not the same as someone earning £100,000 now because of inflation, because of wage inflation. And I looked at this and had that 100 grand limit risen with wages in that time, it would be now worth something like 163,000. And look, again, we should say caveat everything we say here by saying, if you're earning £100,000, you're one of the lucky ones, aren't you? Absolutely. You're in the higher few percentage or few percentile, should we say, of earners anywhere, which is, no one should sort of, you're not perhaps the biggest priority here, but in terms of fairness, it's quite striking. If you're in that bracket anywhere between 100 and 163, you'll be like, well, yeah, my tax bill would be significantly lower had it simply kept pace with wages.
Yeah, I think there's a fairness issue, but I think there's also just a sort of an incentives issue. I mean, if you are essentially telling people that, and these, as you say, these will be sort of ambitious, hardworking people who are, looking to get on. If you're saying that, if you get a pay rise, we're going to take 60% of it back, that is a pretty big disincentive to get promoted, to earn more, to work a bit harder, and for a country which is trying to increase productivity and become more effective and more efficient, that seems slightly odd. Yeah,
and it's actually not the only thing that happens at £100,000 either. There are potentially other effects because of wider details of the benefit system. There's a free childcare, which is very, very valuable to parents. That gets removed as soon as someone earns above £100,000. If you added in that effect, that would be another dramatic hit to your effective tax rate. You're going to pay 2% national insurance, higher rates in Scotland, by the way, on income tax as well. We focus on the England and Wales figures here.
And the people that are likely to be caught by this, the ambitious young people, they're also probably paying 9% of their earnings above £25,000 on paying off their student loan.
Yeah.
So I think for that cohort of people, the sort of youngish, ambitious, hardworking people, there are a lot of tax disincentives.
Yeah, and the reality is, you mentioned a disincentive to take that promotion, to take the higher wages. Well, because if you're going to only keep a fraction of it, why take on the hours? Why strive to take the risks in your career to earn more? There is mitigating sort of, or ways to mitigate this, I should say, and one of them involves pensions. So what is that?
Yeah, so because essentially, money that you pay into your pension is taken before taxes is considered. It's a pre-tax contribution. If you are able to contribute more into your pension and effectively bring down your taxable income to that 100,000 threshold, then that is a very sensible way of avoiding that 60%, effective 60% tax rate. So, if you were earning £105,000, for example, then, it might make sense for you to pay that extra £5,000 into your pension, bring your taxable pension down to the 100,000, and you'd effectively save the 60% tax rate on that amount.
Yeah, and lots of people will do that. They probably will take the promotion, but then they'll shovel the money into a pension, which is, good for them, but it's going to create, you think, in years to come, huge discrepancies or sort of extra inequality in the system. Already we have inequality of earnings, and people are going to have very different pension outcomes. But when there's a whole cohort of people who are incentivized really to put much more of their money and earnings into a pension, you're going to feel that in a decade or two's time.
Yes, absolutely. It does. It will create more inequalities. There are kind of mixed messages here because, on the one hand, that's making pensions more attractive. And then there are other things going on, such as with IHT on pensions indeed, that make pensions less attractive. So, anything which muddies the water in the way that this does, I think is again another disincentive to do the right thing.
Yeah, indeed. Okay, so before we go, Tom, we do have a budget coming up. Reports are swirling, as they tend to, about potential tax changes. We have actually seen one or two reports that the Treasury is considering a genuine, penny on income tax. But as we've seen and as we've discussed, there's many allowances, thresholds in the system that you can change, tweak or freeze, which will raise revenue. There's a lot of things they can do short of a additional penny on income tax.
Yes, and I have to say that, it seems to me that a fairer thing to do would be to to be clear and honest and to raise income tax by a penny. I mean, it could be offset with a national insurance. There are things that can do, but it's very unlikely to happen for the reasons that we've already spelled out. Because the simpler thing, because people don't really understand it particularly well, is to do this slightly sneaky fiscal drag, and I think that is what will happen.
Yeah, and look, there would be a question there about whether that's breaking a manifesto pledge. It kind of is raising more through income tax. Whether that qualifies as a rise in income tax, I suppose that's a political discussion. All right, Tom, we've covered absolutely loads there, so let's leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you're going to get updated content as soon as it is released. Like the channel, share the episodes. It helps people find what we're doing here. That said, Tom, thanks for joining me.
Thanks, Ed.